silver market just crossed a line that nobody is talking about. In the first 3 days of the latest delivery month, nearly 18 million ounces of physical silver changed hands. That's roughly 40 pounds per box, truck after truck, pallet after pallet. And here's the uncomfortable question. If silver is just a side metal like Wall Street keeps telling you, why are institutions quietly moving this much weight while mainstream finance pretends nothing is happening? Today, we're breaking down 5 specific reasons why silver could be setting up for one of its biggest moves in decades. No hype, no rockets, just the mechanics behind the metal. What's going on, Money Minds? Welcome back to Money Mind Hub Pro, the channel where we cut through the noise and break down real market signals. If you're new here, we focus on smart money moves, market mechanics, and the forces that actually drive prices. Not predictions, evidence. Quick disclaimer before we dive in. This is purely educational content. We're not financial advisors. Always do your own research and manage your risk accordingly. All right, let's get into the 5 reasons. First up, the structural supply deficit. Here's where most people get this wrong. They hear shortage and think it means empty shelves tomorrow. That's not how commodity markets work. What's actually happening is slower and more dangerous. In 2026, global silver mine production is estimated at around 985 million ounces. But total demand? That number crosses 1.1 billion ounces. Do the math. That's a deficit of roughly 117 million ounces for a single year. Now, here's what makes silver different from gold. Gold sits in vaults. It gets recycled. It comes back to market. Silver? Silver gets consumed. It gets smeared into electronics, solar panels, medical devices, and most of it never comes back. Think of it like ice cubes in the sun. Gold is the ice cube in your freezer. Silver is the one melting on the sidewalk. The deficit isn't just a number, it's a countdown. Reason number 2, inelastic industrial demand. Let's talk about who's actually buying this metal. And it's not your neighbor with a coin collection. The solar industry alone now consumes nearly 30% of all silver production. Companies like First Solar, Longy Green, Canadian Solar, and Trina Solar are locked in a race to build capacity. Every single solar panel requires silver because it's the most efficient conductor we have. There's no substitute. Not at scale. Not yet. Then you have the technology sector. Samsung, Apple, Nvidia, Intel. These companies need silver for semiconductors, for 5G infrastructure, for AI data centers. We're talking another 12 to 15% of annual production. And don't forget electric vehicles. Tesla, BYD, Volkswagen, General Motors. Each vehicle contains somewhere between 0.8 and 1.6 ounces of silver. Sounds small until you multiply it by millions of units. Here's the part that should concern you. These industries don't care if silver is $30 or $100. What they care about is whether they can get it at all. Because if they can't, production stops. Period. Number 3, and this is the signal most retail investors completely ignore, the gold-silver ratio. This might be the most important one. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 40 and 60 to 1. At extreme lows, it has dropped below 20. Right now, the ratio has been compressing from the mid-80s down into the 50s. That's not a random wiggle. That's capital shifting its weight. Now, let's do simple math. If gold stays around $3,000 to $4,000 and the ratio compresses to 40 to 1, you're looking at silver prices between $75 and $100. If it overshoots, which ratios often do, triple digits become a real conversation. This isn't fantasy, it's just ratio math. And ratios don't stay stretched forever. They snap back. The only question is whether you were positioned before the snap or watching from the sidewalk when it happens. Reason number 4 is geopolitical supply risk. Here's the part of the story that rarely makes headlines, but absolutely should. A significant portion of the world's silver refining happens in one region. And recently, that region has been consolidating export licenses, restricting who can ship refined silver, and essentially nationalizing the export process. What does that mean for the rest of the world? It means the window is getting narrower. Fewer refiners can ship, permits get harder. And if that refining hub processes a majority share of global silver, every policy shift ripples through the entire market. Western vaults are seeing big delivery demands. Replacement metal needs to come from somewhere. If the flow out slows while demand stays high, prices have to adjust. It's simple physics. Less supply plus same demand equals higher prices. This is the signal that should make every serious observer pay attention. And finally, reason number 5. Institutional behavior is changing. For decades, big banks and global players passed metal back and forth like chips at a casino. Paper claims, promises, IOUs. Everyone smiled, everyone hedged, everyone pretended the paper was as good as the thing. But something is changing. Large amounts of metal have been moving from one major institution to others, and those recipients, aren't just taking paper claims. They're taking delivery. They want the bars. When the players inside the machine stop trusting each other's promises, the machine doesn't explode immediately. It grinds, it squeaks, it gets jumpy. And then one day, it reprices violently and pretends it was always obvious. If institutions are quietly accumulating physical metal, the question isn't whether they know something. The question is what they're preparing for. Now, we have to be fair here. None of this is guaranteed. Silver is volatile. It can spike 10% and drop 15% in the same week. January typically brings forced selling due to index rebalancing. Portfolio resets create artificial pressure that has nothing to do with fundamentals. If we're wrong, where will it show first? Not in headlines. In delivery stress easing, in premiums collapsing, in physical bars becoming easy to source again. Until that happens, we assume the opposite. Tight metal, nervous paper, and a ratio still compressing. I want to hear from you in the comments. 2 questions. First, if institutions are taking more physical delivery, what do you think they're preparing for? Higher prices or delivery risk? Second, if refining exports tighten at major choke points, where does the West get replacement supply? More mining or demand destruction through higher prices? Drop your take below. Let's build this conversation together. If you found value in this breakdown, smash that subscribe button and turn on notifications. We're tracking delivery data, ratio movements, and the signals that actually matter. No hype, just the mechanics. Because here's the truth. Silver will try to throw you off like a bull. It will spike, crash, fake out, and rip again. That's not a reason to panic. That's a reason to understand. The question isn't what the price is today. The question is, where's the metal going, and why isn't it coming back? This is Money Mind Hub Pro. Stay sharp, stay informed. And we'll see you in the next one.